Hello and welcome to another episode of Monday Markets. As always, they're brought to you by Woo. Links available in the description below. We'll talk about BTC, ETH, a couple of altcoins, and maybe some future stuff. I was looking at the sort of perps earlier on my chart, specifically open interest, funding rates, liquidations, etc., to see if there was a recent example that could be interesting. There really hasn't been. Aside from the more obvious signals of looking at large outsized liquidations and changes in open interest for some sort of mean reversion signal, there really haven't been many signals on BTC and ETH as far as big divergences with open interest, funding rates, etc. It's been reasonably in line. From a process point of view, the way I'll typically do this is I'll go on Velo to start the day and go into futures and look at what the 3-month annualized basis is. So this is if you take the difference between the index price and the quarterly futures price and extrapolate it, whatever that premium is or the discount is, to a year. That's essentially the sort of risk-free yield, if you will. Obviously, it's not risk-free, but that's sort of the return that you'd get by buying spot, selling futures. And it's just another way to sort of look at the premium in the market, right? So just like your funding rates, you can get a sense of how dislocated is the perp from the index. By looking at the 3-month annualized basis, you can look at how far or how dislocated is the future, the fixed term future from the index. You can use these two things in tandem. Sometimes there's sort of funding rate fuckery going on and it sort of gets a bit noisy, whereas if you look at the quarterly basis, it's much less likely to get noisy. So looking at both makes sense. I'll then look at funding rate and sometimes I will also, if I'm looking on slightly lower timeframes, I will press the dollar sign here and sort of overlay the BTC price to see if there's any big divergence between what the futures are doing and the price of BTC. So in this instance, actually, you can see more recently that the market has been walking up as far as BTC price, but futures have stayed at similar levels to the lows, essentially. So that's a sign of the bid essentially being more spot oriented than not. We've had a couple of instances of spot premium, spot book depth being deeper. Spot delta isn't an amazing example, but just in general, it's suggesting that this entire sort of bounce isn't leverage driven, which is quite good. In other cases, you'll get examples where the price is essentially doing nothing or staying in the same range. And then the futures and premiums across the market start to do this. Now, that's not a signal in itself, but contextually, it either means someone knows something and they're just racking up positions and slamming the perps, even if spot is not moving yet. More often than not, it is just a bit of a sort of leverage signal that perps are really trying hard to pump this thing, but the market isn't moving, and so you'd expect for those positions, at least the most aggressive ones, to sort of get liquidated and for these things to start trading back together. So in most cases, if I'm looking at any type of funding interest stuff, funding rate stuff, open interest stuff, etc., most of the time it's quite boring. The few times where it's not boring and gets interesting is when there's a divergence between price and premiums in the market. So with that in mind, as I said, quarterly basis, nothing too crazy yet. I mean, it's nice that BTC has recovered without the help of the quarterly futures, and there isn't a ton of premium on the back of this rally. That's a good sign. We discussed on Casual Friday there was some negative funding as well on the back of that. So that's nice, but this isn't like a massive signal in its own right. It's just sort of one puzzle piece, one observation. So after I look at quarterly basis and funding rates, you can see, for example, for BTC, currently, actually, unless this is wrong, although I don't think it is, if we have a one-day view, Hyperliquid at 6%, Bybit, which is historically quite aggressive, at 0.69%, Deribit is negative, Binance is negative, OKX is negative. So you can see even here how those two puzzle pieces complement each other, right? So initially, we looked at the quarterly basis and we said that, hey, BTC price is up, but futures are flat. So it's not futures that are pushing this thing, it's more sort of spot oriented. And then to confirm that view, we looked over at the perp funding rate to see if it complemented that analysis, and it did, because we're seeing in major venues that funding is negative, which means the perp price is trading below the index price, and so whatever's pushing the market up, it's not the perps because they're below the index. Remember, index is spot, right? A basket of spot instruments, and the perp are your leveraged instruments. So if funding is positive or very high, then by definition, the perp is trading above the index, and that acts as an incentive to buy spot, sell the future, and get the difference between these two things to be a bit closer. The reverse of that is obviously when perps are negative or trading reasonably in line with the index price, but the market is still growing up. So we know in that case, if the perp is below the index, the sort of driving force is unlikely to be the perp because by definition, spot is trading above it. Now, obviously there are some exceptions, like when you get mass liquidation events and the leverage that is inherent and intrinsic in perps just forces that thing way lower. And so you have more people getting wrecked on the perps because they have leverage. And so even if you initially had perps trading above index, you get liquidations, right? And then you get you get the index trading above the perps, right? So let me just clear that up very quickly. We can actually do this slightly neater. Apologies. We might as well get into this, right? Not that there's a ton to talk about with the market itself. So the following relationship is important to know. Funding rate equals the difference, the basis essentially, between the perp price and we can do versus index price, right? So the perp is obviously the perpetual future, the thing with leverage that we all trade, and the index is a basket of spot instruments, right? So that's the first relationship to understand. So if we are in a scenario where the perp is trading above the index, P above I, that means that the funding rate will be positive. And that also means that if you are long on the exchange, you pay the funding rate. And if you're short, you receive the funding rate. And the reason the funding rate exists is that if this thing really starts to run away from the index price, there needs to be a way to keep these two instruments close together, because the whole point of perpetual futures is that, hey, it's basically like spot. You don't need to worry about rollover. You don't need to worry about expiry. It's all good. It's just spot with leverage. So obviously it becomes a problem for the product if these two things become very disconnected in terms of price. So if the perp is significantly higher than the index, then funding, this thing, goes up a lot. And so the amount you get paid to be short also goes up a lot. And by definition, the cost of being long, if funding is high, is also increased. And so the incentive, the way sort of the funding rate keeps these two things in line is via incentives for the trader. So take an example again where funding equals sort of very positive. How do we fix that? We fix that by making it expensive to long. And we fix that by making it, how do I say this? By giving you money, give money to short, right? So the way this leg works is the higher the funding rate, the more you pay every 8 hours for your long positions. The way this one works is that the more you get paid to be short this market. And the sort of combination of these things, especially this leg, creates your sort of delta neutral or these nuts setup, where you buy spot, sell the perp equals arb or collect the funding rate. Okay, that's essentially the most basic relationship. So again, from scratch, the funding rate is a derivative of the difference between the perp price and the index price. The perp is the leverage thing, the index is the spot thing. The whole point of the funding rate is to make sure that these two instruments stay reasonably close to each other and don't get totally disconnected from one another. If funding is positive, that means the perp is trading above the index price, and by baseline, that is usually the case. If funding is negative, that means that the perp is trading below the index price. And so when there's a divergence or a sort of a large difference between the perp and the index price, or the more this sort of disconnected these two instruments become, the greater the incentives are via the funding rate mechanism for them to be close to each other. How do those incentives work? Well, in a positive funding scenario where the perp is starting to run away compared to the index, the way the market, the way the sort of funding rate incentivizes these things to trade back in line with each other is in two ways. One is it becomes more expensive to long. The bigger the difference between the perp and the index, the higher the funding rate. And if you're long in a positive funding environment, then you pay that funding to be long. And so the greater the difference, the more expensive it is to long. So some trade, it's incentivizing traders not to be long, or at least making it costly. And the other leg of it is that if funding is very positive, and the more positive the funding rate is, if you're short, you actually get to collect whatever that every 8 hours percentage-based number is. And so that in itself incentivizes, or is supposed to incentivize you to short. They're like, hey, I can just short this thing and get X%, whatever the funding rate is, every 8 hours. But even if you don't want to take that sort of directional short, what you can do, and what is often done in these cases, and there are funds that operate exclusively using this parameter, is that, okay, the fund, I'll get paid a lot of funding to short, but I don't really just want to be naked short the market. How do I fix that? And that's this sort of funding rate ARB setup here, where you buy spot, you sell an equivalent amount of the perp, so your overall delta is 0, you're hedged as far as market direction, and the only variable that affects you is that funding rate. And again, you buy spot, you sell the future, and because you're short the perp, you collect whatever that funding rate is without having directional exposure to the market, right? I've probably butchered that, but you asked for the video, and I've done a way better job in writing, I feel like, but maybe some of you are more visual learners, although that was really unplanned and messy. So to go all the way back to what we looked at here, we initially said that looking at premiums when viewed through quarterly futures, the market seems to be marching up, but the quarterly futures aren't getting super leveraged and they're more or less staying flat. So the perps and the futures and the speculators, if you will, aren't strictly what's driving this bounce. And then we looked over at perps to complement that view, or see if there's any kind of conflicting signal. And what we saw was, if this is 0% here, as it's delineated, that the perps are mostly trading at baseline, or actually slightly below the index price. So here we have evidence of the market going up and it's not being futures driven. And here we have evidence of the market going up and it not being perps driven. So in general, you can start to build a view that this bounce thus far isn't driven by leverage. And that's not altogether surprising, given that most of the leverage, or at least a lot of it, got wiped out on the move down. But still, that's sort of the starting point. Most other times, I will then go to my default chart layout, which chose to reload itself, which is very generous of it. And I look at three things. There are some other websites and other indicators, and Trading Riot, or Adam, has a really nice blog where he looks at spot book depth and other things. I don't trade BTC frequently enough, or intraday sufficiently frequently to care too much. When I do, this tends to be enough just because I know it well. I'll be looking at open interest, which is just the value of open/outstanding positions in the market. I'll look at funding rate, displayed as these bars, which is the thing we very much discussed. What is the relationship between the index price and the perp price? Is if funding is negative, then I know that the perp is trading below the index price. If funding is positive, I know the perp is trading above the index price. That, of course, is not in itself a signal. It's always with funding a question of degree and divergence. Remember, the two Ds when it comes to funding rates are degree, sort of how positive or how negative is funding, and then divergence. Even if it is very positive, if the market looks like this, who gives a shit? Even if it is very negative and the market just straight nuking, who gives a shit? The market is in line, it's reasonable to expect to pay a lot in funding if the thing is mooning. It's reasonable to expect to receive a lot in funding, assuming you're long, if the market is nuking and they're trying to incentivize someone to come in and save the damn thing. The interesting things happen when there's a divergence. So again, degree, how high, how low, divergence, is the extent to which it is high or low justified by price action, right? So that's the funding thing. And then just liquidations, standard kind of mean reversion signal, or just to see how many people are getting wiped out, the magnitude of the wipeout. It can also sometimes give you hints. If the market is sort of moving up very slightly and then you see a large amount of liquidations, you can kind of piece together that a lot of participants are pretty sensitive and or over leveraged, because a small move in price is triggering a lot of liquidations. So that can either mean those participants are very leveraged, or the market is technically approaching an inflection point where a breakout of some sort is starting to form. So that's really the process here. I can't emphasize enough those two things, degree and divergence. Most of the time, if this one isn't here and the market is just generally playing along with what you'd expect, and there isn't any kind of crazy difference between price and open interest, or price and funding, or price and a combination of open interest and funding, I'll just assume that there's no signal there. I think when you're trading this kind of stuff, as soon as you discover it, it's very tempting to become a full-time tea leaf reader and try to find every 5 minutes slight move in open interest and be like, there we go, the entire market is trapped. There's a setup here. In most cases, this stuff is noisy and or basically tracks price, or at least isn't diverging from prices. It's not interesting. So that's why I would emphasize looking at these two things. Currently, there isn't anything crazy going on, not in my view, in terms of either open interest, funding, or price. I would say that there's evidence of spot strength, as seen via most venues having baseline and negative funding, and quarterly futures staying at the same levels despite price bouncing. So that's one data point, essentially, one sort of joint one, that there is some spot strength in the market. Other than that, it's been mostly flat. I mean, funding rates kind of bounced back and forth. We've had some negative periods, but they haven't nuked. That's good, but that essentially affirms the view we talked about moments ago. And in terms of open interest, it's been more or less sort of stable within this range, and there hasn't been anything crazy price-wise. So it might become interesting if we see sort of a real turn up in open interest to see how the funding rate reacts, and also obviously how the technicals react. And it's best to look at these things at either sort of high time frame levels or breakout/breakdown levels. So in this case, I think 62K for low time frame trading would be a really good one, because we know that's like a big technical inflection point and a breakout point, right? So for example, if the market were to start to march higher, and we were to see funding, for example, get even more negative, then that could be a sign of essentially disbelief on the perp side, that they're sort of adding to their shorts or fading the rally, and would likely end up as one of these liquidations if the market were to pierce through that level. You could also use it as signs of exhaustion. So for example, if heading into the breakout, the reverse were to happen, open interest starts to spike really aggressively, premiums really flood back into the market, and everyone sort of positions for a big breakout move, and instead you get a little piddle and back down, well then we can then extrapolate that a bunch of that open interest and a bunch of those likely aggressive buyers are trapped and look to trade it the other way. But you see how using the same indicators, we essentially can get two different views depending on how they're positioned heading into these important technical levels. In the first scenario, we outlined a case where net open positions were increasing in the form of an open interest increase, but a lot of those positions were likely to be either aggressive perps or spot being bullish. Because there's an open interest increase, and if funding were to become more negative, I think the more plausible explanation is perps becoming more aggressive on the sell side than simply sort of spot strength. For example, if this funding were to become more negative and open interest were to go flat, I can't reasonably argue that, a bunch of new positions have entered the market, because they sort of haven't by definition, right? So for example, if this is flat, this becomes more negative and the market is approaching the breakout level, I'm like, okay, well, the perps don't really seem to budge or care, but spot is pushing this thing, so that's potentially a good sign of a breakout, and I'm not expecting kind of a crazy liquidation type of candle, because there's no one to be super liquidated in the first place, right? Open interest is pretty flat. So that's kind of the neutral spot is strong scenario. What about the bears on perps are horny scenario? We'd expect a similar increase in open interest. We'd expect funding to get more negative if the perps are going to be aggressive sellers on this thing, and then if the market were to approach the breakout level and really start to push and find acceptance, I would then speculate that whatever built up open interest is going to look like this. Funding would return likely to baseline from those shorts getting liquidated and the perps being pushed higher, and then I'd expect to see long liquidations here, and look to position on acceptance above that low time frame level, right? And then we take the, oh my god, the leverage is back and they're here to buy the breakout type of setup. What I would expect to see is, again, approaching the high time frame sort of breakout level, technical inflection point, whatever, a commensurate, or perhaps even ideally a disproportionate increase in open interest. Again, double Ds, right? Degree and divergence. So if open interest really starts to skyrocket and prices barely moved like 2-3%, that's also kind of signal that, hey, these people are really horny for this move, right? So let's say we get a disproportionate increase in open interest, and then before the market has even broken out, the funding rates go not only back above baseline but start trading at a sort of significant premium, let's say even higher than the last high. This is the last high here, and we're already pre-breakout have a bigger difference between the index price and the perp price than at this high, well then if the market were to at all stall or slow down or start trading below, then I could come to a view that, hey, everyone got really fucking aggressive into this breakout before it even broke out, but now now that it has broken out, it looks pretty weak. And those positions, if the market starts to accept back below the breakout level, that entire new chunk of open interest is probably going to puke, and you can look to trade that lower. Sometimes you can see this develop in real time if you're looking at sufficiently low timeframes. So one example could be that as the market sort of breaks out and starts to stall, you actually get a sort of increase, a subtle increase in open interest, but premiums get jacked all the way up. And at that point, I often extrapolate that, okay, there's the sort of net amount of fresh positioning isn't massive, but it's entering at this price. It's being horny on the perps, and their only saving grace is if the breakout sticks. If the breakout doesn't stick, then even if the increase in open interest isn't massive, though all of those positions are betting on the breakout. So at the very least, I'd expect, if they're wrong, a flush back down to the pre-breakout level, and for this thing to trade back in line as well. And that can kind of give you a hint that this thing is going to turn around, right? Specifically, even without waiting for the market to turn back down, if you have open interest basically not budging or budging slightly, but then premiums spike up massively during that time, then it's like, okay, why the fuck are all these people getting long if the market isn't moving? And the longer that lasts a lot of the time, bear in mind, they're the one making the funding rate payments. They're the ones more likely to be leveraged. They're the ones more sensitive to this stuff. Then sometimes, depending on the context, you can actually take like an early short setup, or on the other side of it, like an early long setup, because you're essentially betting against these people becoming disproportionately aggressive post-breakout. Again, I'm all over the place. If that sounds annoying or it's frustrating or it's not useful, the good news is if you go to my pinned tweet, there's a sort of futures indicators or whatever it's called type of article, which has funding, open interest, liquidations, setups, all of that in one neat article, and it does a better job explaining this than I have trying to do it squiggly ad hoc during the course of this video. So if that's of interest, go check that out. If this was at all helpful, let me know. I'm always one to ramble, and I can do that on demand for this type of stuff. So if you want to hear it, please tell me. From a technical point of view, I mean, unsurprisingly, things are still more or less the same. You know, on the BTC front, same monthly time frame. We've been here for 5 months. Not going to get a ton of signal there unless, you know, we really hit monthly support or really break down or really break out. But there are just better time frames for this. On the weekly, we've essentially gone nowhere since the big wick down. We do have an inside week, so I think any trading, even in sort of medium term or short term, is probably best done above previous week's high or below previous week's low, right? So whenever you get an inside week, which is to say the price action of this week is contained within the preceding week, you can kind of treat it as a mini range. In this case, you get the added benefit that the range high is roughly sort of the inside week high is roughly in an area of resistance, and the inside week low is roughly in an area of support. So you get some confluence there, and you can see if we take those two sort of inside week levels, we're roughly at the mid-range now. So don't deal in the middle, kids, or if you do, don't bet too much on it. And that's essentially what BTC looks like. Quite neat as well, right? You've just plotted our inside week levels, and unsurprisingly, they make for really nice low time frame ranges. So sort of trading plan for the week, if there were one, would be focused on inside week high, inside week low, and nothing else. That's the weekly. And it's quite nice that I get to essentially get a 2-in-1 on the weekly, because the inside week high and inside week low also outline sort of nearest weekly support, nearest weekly resistance as well. I don't think there's anything else that's super relevant here. Daily time frame has, you know, we had a really strong bounce and then it retraced sort of most of it. So, I mean, this is the definition of chop, at least locally, sort of with this strong move down, strong move up, and we end up more or less around the same price. I would say that local daily market structure is still bearish in that you have lower highs and lower lows. If we look at the line chart, reasonably self-explanatory. We talked about this on the weekly before the market dumped, and this is just a less impressive version because the time frame is lower, but still high, low, lower high, lower low, lower high. And so you'd ideally want a higher low into a higher high, and then you get your 60k plus potential sort of breakout signals, and that would look good on the weekly, yada yada. But yeah, summary there is daily time frame isn't anything crazy. If you're looking for market structure shifts, you haven't got them yet. Preferentially, I would stick to those weekly previous sort of inside week high, inside week low levels. This price action here is nothing to write home about. On the ETH front, we know Don loves it. We talked about it on Casual Friday with the sort of first test, best test on the weekly and on the monthly. I think it's pretty good. in terms of sort of the bounce we've had. It's always tricky after the big bounce to then position for it. I'm not very good at that, and I think in most cases it doesn't make for amazing trades. In this instance, I would probably prefer to wait for, if it wants to backfill the wick or at least try to carve out a higher low in 2400s, I think that's okay. But buying strength on ETH, I think there's just a really sort of self-evident flip type level at, depending on how you want to delineate it, 2900, perhaps 3K for the momentum signal. On all time frames, that's just your really high time frame multi-touch range low, right? Lows, 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 lows all over the place. And I think just from a sort of systematic trading signals perspective, you'll get a bunch of buying above there. Anything else is significantly less interesting. We had a triple drive here, didn't go anywhere. The highs didn't break, the lows didn't break. So you can either take your signals locally here, if you're really low time frame trading, or otherwise on the high time frames are only interesting sort of above 2900 or on any retests of the lows or the wicks or what have you. From an altcoin point of view, Solana I don't find it particularly interesting at this particular juncture. As we've discussed before, this whole 125 million tests in a row, I'm sure some people trade it very well. I tend to mentally check out after like 3 tests, so I'm well away from this level unless it really wants to just 6K BTC style wipe it. I think that's a buy. If it wants to, anything else is difficult to fathom. Not in that I think this is going to happen, but just from a trade perspective, realistically, it's either going to be breakout trade and hope you don't buy the top at 180, or it's nuking, but I'm going to buy support and hope it's not zero. That's the only interesting thing. This thing's been ranging for fucking ages now, much like the rest of the market. So I'm not going to try to be a genius here. With not super interesting poster child as it may be, I think a lot of the market participants got really keen on this reclaim of 150-ish, and that did look decent for a minute, but it's always that that same risk that we discussed. Whenever you're dealing with a reclaim setup and you're sort of targeting the other side of the range or the extremity or whatever, sometimes you have to bear in mind that this is just a breakdown bounce corrective leg that forms a lower high and trades back below. And there are ways in which you can increase the probability of it being legit versus not, but in most cases you're gonna have to just bet, right? Every time you sell a lower high, you could be wrong because it's going to go to the other side of the range. Every time you buy a reclaim, you could be wrong because it makes a lower high. That's just trading. That's just business. Weekly Pepe, it kind of lost the main sort of driving level for this thing, which is around 880, or if you want to be charitable, 840, sort of sub 900, reasonably self-evident, previous highs turned lows type of level. I don't want to be on the wrong side of this weekly flip. So if it wants to change that, fantastic. If it doesn't, high, low, lower high, lower low type of structure as well. And that's sort of a prevailing theme here. Tron, because Justin Sun has decided to attach himself to another narrative, has been really strong with Tron Chain and people doing meme coins on there now, etc. The only thing I'll say about Tron is when you get a chart that looks like this, and it's just like completely mental, especially this most recent leg, no pullbacks and just mooning. Look at the low time frames getting walked up completely. If I want a piece of this, I'm not looking for high time frame pullbacks, because at that point the whole thing is probably cooked. The way to approach this is either via very low time frame pullbacks from a TA perspective, or ideally low time frame pullbacks that have open interest flushers and some liquidations to boot. So for example, if we were to look at TRX and we look at some of the recent things, notice what has happened in the pockets where we've had some, tiny amounts, but relative decreases in open interest, right? So if we take this walk up, for example, where it really started, this thing's been going crazy for a while. But if we look at the most recent leg, the most aggressive leg, decrease in open interest as the market nuked and some longs got flushed, ended up being the bottom. Decrease in open interest, if you bought this early, you've had a rough time with it. It's not a single period. The whole time frame thing is arbitrary. But whenever you got this kind of mini flush and some instances of open interest getting lower, not higher, at least for this thing, that ended up being the bottom. Same thing here, right? Open interest for a change just stops increasing and some of those positions get flushed, ended up being the low, and so on and so forth. This thing is just getting completely walked up. The most likely route for this thing is it just keeps getting walked up until at some point it just breaks market structure. You buy the dip too early, it gets a slight bounce, and then just eventually sort of bleeds and makes its way back down. But it can go sort of irrationally high until it does. So you either stay away from this thing and look to trade the sort of break in market structure, like a proper, higher time frame parabola loss or break in market structure or whatever, and then you're looking for any type of bounces for a lower high, but the high is your invalidation. Or if you're looking to long this thing and get on board whatever the fuck this is, then low time frame flushes, I think, are your best and only option. Yeah, that's it. This video is way too long. I'm sorry for taking up so much of your time. Thank you for listening. If you have, as always, the show is brought to you by Woo. Thank you to them for some reason for giving us money, but also the exchange is making big strides and has some very good updates, features to their liquidity. There's isolated margin now if you missed that, and I mean, they've been good to us. So reputationally and transparency wise, there's the execution dashboard, transparency dashboard, all this other stuff that most people sort of don't care about, but especially in crypto, you should. So if that sounds like a cup of tea, check them out via the links in the description. That's all from me. Like, subscribe, do all the normal stuff, comment if this was useful or useless. I'm going to shut up. Have a wonderful Monday. This video is late. I'm sorry. Bye-bye.